Five, four. Right. Hello, everyone. I'm Zahid from Talks at Innovation Valley. Today, we have a very amazing guest, Jordan Olivas, who is Executive Chairman of QisstPay, which is basically a FinTech company. So, first of all, I really warm welcome you, Jordan. Thanks for joining.
Hey, thanks for having me. I really appreciate the time. Looking forward to our chat.
Thank you. And our topic today is FinTech and e-commerce startups. Build, launch, and scale. Jordan will be guiding the startup founders and young entrepreneurs actually that how they could build the fintech and e-commerce startups and what are the challenges and everything. But Jordan, before we jump to the questions list, I would love my audience to know your personal story so far, where you got your education, how was your, when was your start in the professional field, and how you got into the startup domain, and how was the journey so far?
Yeah, so look, I come from pretty humble backgrounds. I think as I've kind of jumped into my entrepreneurial journey, there was a big misconception that I come from like a trust fund or went to some Ivy League school. No, I actually grew up in a very small poor town, uh, grew up with pretty humble means, and was very, middle of nowhere in New Mexico. That was quite, you know, quite an interesting place to start. Now, for myself, I went to the University of New Mexico, then University of North Texas, and I started in payments almost right out of college. So I was working for a fleet management company, and one of the things that was interesting is that they had uh, they actually had a payments division focusing on Wex and Voyager fuel cards, which is, if you're familiar with Motive, is very similar to what they do, or a piece of their business does. So after that, I was moving into the payment scene further and further. So I did bill payments for utility and a government sector. So I traveled across the U.S. and sold into those entities. After that, I worked for a software house where we built private label credit card platforms, payment gateways, did EMV certifications. I'm really focused on the software side of building fintech platforms. After that, went to Klarna, was one of the first sales reps that they hired for their pay in 4 expansion, which was a awesome journey. And after that, went and became the VP of sales at Charge After, where I helped build the sales team to what it is today. Was able to open up the doors at a number of multi-billion-dollar industry companies, and all at the same time while building up the SDR team into a pretty robust organization. And after that, started QisstPay, where I was the co-founder and CEO. I'm now the executive chairman, and QisstPay is an embedded finance platform. So what we do is that we aggregate local payment technology, and then we supplement it with our own technology layer, and we go out and we essentially sell this out to large enterprise organizations while giving loans to consumers. So, for example, we'll give B2B loans to businesses in the local area, and then on the consumer side, we have different types of loans that we do, but we do this primarily in Pakistan. And then one of our fastest growing business arm is our software house side. So we have a software house within QisstPay, our services arm called QisstPay Agency, which goes in and provides e-commerce and payments specific development for the global markets. So it's been a pretty good journey. Now I'm not in the day-to-day to QisstPay. I still obviously talk to the team, help with a few strategic initiatives, but I'm very high level, and so it's been really good to kind of take a step back and really be able to take some time to focus on a couple of the companies that I advise, like Paying Tone, and a few others. And it's been a great journey, and wouldn't have it any other way.
Right. Jordan, can you please define a little bit these two terms, fintech startup and e-commerce startup? What basically is fintech startup and what is basically an e-commerce startup?
Yeah, great. So fintech is a general term. So I started really in I'm a payments expert. Like that's where I really have really two expertises, and that really lending and then payments. And each one of those arms are a subsegment of fintech, which stands for financial technology. So within fintech, you have acquiring, issuing, network switching, you have fraud, you have payments. There's a number of different subsegments underneath fintech. Where I specialize is really payments and then lending. On the e-commerce side, which is really interesting, is that so prior to Klarna, I hadn't really had a ton of e-commerce experience. It really been payments focus. However, what I found is that a lot of the processes, the technology that's used inside of payments is extremely related to e-commerce. And so when I went in, it was a very natural fit to go from a very strong payments background to e-commerce. And I found myself very comfortable that e-commerce is really the digitization of buying goods and services online. And so you have, as an example, of fintech would be Stripe, Affirm, QisstPay. Well, on the other side, e-commerce would be something like an Amazon, or you also have platforms like Shopify, BigCommerce, WooCommerce. So there's a bunch of different, once again, subsegments of e-commerce, but the two are very tightly knitted because at the end of the day, you have an e-commerce journey, but at the end of the day, you're trying to get them to convert and buy something. So payments and really fintech and e-commerce are very closely interwoven. However, there are differences. You do find a number of crossover paths between the two different fields.
Right. Jordan, nowadays, worldwide, the culture of startups and entrepreneurship is, getting hype. Every college university student wants to start the startup. So, what basically is the mindset that a potential entrepreneur needs to kick off his or her own startup, and specifically what challenges they could face when they start a fintech or e-commerce startup?
Yeah, so I mean, I think the number one thing you should be aware about is that you're going to lose some hair. I used to have quite a bit more a couple of years ago. And look, it's a tough journey. I think a lot of times startups are very much glorified by the media, and it's great exposure. And I think it's great to have that encouraging mindset to get people to go out there and do something on their own. But look, it's a tough journey, and I think when you look, I've done startups. I've worked in startups. I've built my own startup. One of the major differences in what's happened between now versus maybe even a year ago is that the idea of how startups interact with the ecosystem and the overall metrics. I mean, a year or two ago, it was just grow, grow, grow. QisstPay actually was very close to profitability a while ago, and I was advised, hey, don't use that word profitable with VCs. It just means you're not growing fast enough. Now it's, hey, profit's number one. If you're not making a profit, you're not going to get funded. I mean, that's not a blanket statement, but I think it's a general consensus for 80% of the cases is that the metrics have fundamentally changed, right? And you talk about one of the most common questions I get about startups is, what are the fundamental differences between a small business and a startup? And I think it's really about the growth trajectory, right, of what you're looking to achieve. A small business is okay with, you know, you know, 30-40% year on year growth. Well, with a startup, especially early stage, you want to be seeing 30% growth month on month, right? So the overall metrics of growth are fundamentally different. And one of the things that I get out there and really push very heavily is I get reached out all the time from different founders in the U.S. primarily, also been in Pakistan as well, of course, asking, hey, I need funding for my startup. And my first question is, well, how much profit have you made? Or how much revenue have you made even? And many times the answer is little to none. Well, I need this funding to be able to do this. Well, if you go with that mindset, unless you have a really, really good pedigree, you're a multi-founder, you were, the head of product at Apple or something, unless you have some sort of kind of unique use case, most of the time you are not going to uh, get funded. Like in this environment, it's a couple of years ago, it's very different, and a lot of people are still looking at it like that of saying, "Hey, well, I saw so and so got funded." It's like, well, it was a different time, right? So focusing really on your number one core metric is what's your profit, what's your revenue, right? These are the two things that you should be looking at. Growth is still important, right? But if you're talking pre-seed as a founder, you need to focus on hey, is there actually a product market fit? You'll hear the term PMF, product market fit, and that's really validated from revenue. Look, you may in the early stages, if you're not funded, it's hard to grow, 100% month on month. It just is, right? But if you're bootstrapped, you're showing 30% growth month on month, and you've got a strong pipeline, and the early reviews are in, it's going to be much easier to go out and get funding. And I think it's important to start those relationships early with the VCs and the angel investors, but many of the times people are just getting funding to get funding rather than saying, hey, we have product market fit. We have sales, but we really want to turbocharge this, and we want to go to the market really, really hard. And so that's why we need funding. But they've yet to prove in PMF, which is a common mistake I see upon early founders.
Right. Jordan, when somebody wants to start the startup, the first thing that usually comes to mind to the new entrepreneurs is funding. Do you think funding is really important in start? And many potential entrepreneurs, especially students from the universities, they say, "I have amazing idea. The problem is I don't have funds. I don't have finances." What is your comment on this?
Yeah, so look, it's the fundamental issue of the reality of the world, right? And we actually have this. It's a bright pink neon sign inside the QisstPay office that says, "Ideas are shit." It's what it says in bright pink, right? Because look, everyone has an idea, right? I know I saw the other day a startup that they do analysis for Olympic lifting, and so what they'll do is they'll set up the app and they'll say, hey, your form on your squat is good, the form on your uh, bench is good or bad or whatever. And I heard that idea like three different times in the past 10 years, right? But the reality is they didn't execute on it. If and like look, some businesses need funding to get moving. Like so anything in lending, unless you have a debt book or a massive amount of equity, it's very difficult to scale a lending business without that, right? So in that case, you do, but you could still find PMF, right? You'd be like, hey, look, we're only doing 2 loans a month, but we are showing PMF. And when QisstPay started, we didn't have a ton of funding. Like I was self-funding it. I'm not a crazy wealthy person. I'm not driving a Lamborghini. I drive a Ford. My wife drives a Ford. Like we're not, like we didn't have a ton of money, but what we wanted to show is that we have merchant signing, we have transactions happening, we have PMF, and I think that was, a lot of people think, well, these startups that come in, they just have they pitch an idea and they get funded, and it's like no, most of the time they've actually been in the market for a while. They're proving PMF in the background. Or once again, as I mentioned earlier, they have a really good pedigree. So if you think that your business needs funding to get started, I don't think you're the right fit. I mean, if you tell an investor, hey, I need funding in order to make this work, 9 times out of 10, they're just going to drop you. They're not going to talk to you. It's not worth their time, right? Find a different business. Like it's a kind of very straightforward, unfortunate truth. But if you have to, like, there's so many, if you can't save enough money, like, and it's difficult, right? You need to save it, even if you save like $500, not even $500, like you do it with 100. There's so many free to use tools out there. Like Software is an awesome tool. I love their platform. There is Notion. There is, uh, uh, you know, there's just so many free tools out there that you can build no code MVPs on and get revenue coming in. That, yeah, it's going to be slow. You're not going to see this explosive growth. But if you think that if you tell a investor that you need funding in order to launch, I have this idea. I said, unless you've got some sort of great pedigree, it's not worth your time. Stop wasting your time. Go find a business that you can start with little to no revenue, right? It's something that's the reality. I mean, even for me at QisstPay, like, I invested into a software house, and that's how I was able to fund it, right? Was that, we literally built our MVP in 3 weeks with like 2 part-time developers, and we didn't spend a ton of money on it. But we made it very narrow. We didn't have a merchant portal. We didn't have a consumer portal. We literally had a very basic buggy widget that was placed on top of a website for people to check out, and payouts or everything was manual. Like, it was the biggest pile of crap I think I've ever seen in the beginning. But once again, it proved our PMF, right? Like, people think that adding features is what's going to get customers, and 9 times out of 10, it's not. It's was this one idea that you have, this one feature that you have that you can go out and turn this into a business. So once again, if you need to go into a different business, or you need, like, you can do so many things for free now, right? You can, go out, make a website for free. You can create a no code process for free. There are many things so it's really about, go find a different business if you really think you need funding, or you need to rethink the business that you're on. Go down and say, what is the core components of what I need to build? Go learn these tools over a weekend. You can build an MVP in a couple weeks on your own. I'm not a developer, right? I'm not a developer. I've built a couple no code tools myself, or no code applications using those platforms. It didn't cost me a penny, and I don't know how to code. It's just, you have to get out there and get grindy. And one of my favorite books, actually what I'm reading right now, it's in the background actually, is Fanatical Prospecting. Is people are afraid to pick up the phone and call customers. They have this very much build it and they will come mentality, right? If you're afraid to pick up the phone, your startup has a 99% chance of failing. They use the excuse of very regularly, oh, well, we're a product-led company. It's like, no, you're not a product-led company. You don't have a company. You have no customers. You have no platform. You have nothing right now, right? So pick up the phone, call the customers. And I think if you feel like you need funding, you're going to be stuck in that loop forever, and someone's going to do it before you do. And I didn't have, in my world, right, when I started, a lot of people are like, oh, well, you must have had all these great contacts from working at Klarna. I'm like, no, not really. I didn't have any VC contacts. My first investor I got was a cold call. And that's the reality, right? You have to pick up the phone, dial. Cold emails are great. Don't get me wrong, but if you're afraid to pick up the phone, you're not going to succeed as a founder. Not in all likelihood, but with a lot of headwinds. So really focus on either A, new business, B, rethink your current business and figure out what the core component is, and try building it in a free no code tool. There's so many options out there nowadays that you can do a lot more now than what you could even 5 years ago without a single line of code.
Right. Jordan, when a potential entrepreneur wants to solve a certain problem via either fintech startup or e-commerce startup, the first thing is the founder needs to validate that is this really a problem and what is the solution. And the second thing is that he needs to build the product or solution. So when it comes to the validation, what is the best way to validate? The second, when it comes to the product building, is it necessary since day one that the product should be on a very high-end technology? Maybe that could be a simple WordPress website, because usually entrepreneurs think that I should have a very cool AI-based Android app, iOS app, and also Android AI-based web portal. So how to start with the minimum resources?
Yeah, I mean, to give you an idea, QisstPay didn't have an app for months until after we launched. I mean, all we had was a WordPress plugin, right? That was it. That was really it. So you don't need a lot, right? And you really don't need a high end anything, right? And the best way to validate product market fit is really to make money, right? look, when you start your startup, everyone's going to be like, oh yeah, this is so cool. I would totally use it. Yeah, I'll sign up for your mailing list. Like, that's great and everything. Get them to pay something. That's the real way. Be like, hey, you think this tool is great? Awesome. I'm going to be building it in 90 days. Um, I will give you a annual license for $10. And I'm going to be selling this annual license for 1,000 when it launches. If they can't afford $10 or they're not willing to put $10 down on an idea, or at whatever stage you're at, even if it's just a functional prototype, right? You don't have PMF, right? Um, it's easy to get email signups. It's easy to get people interested in what you're doing. Get them to actually pay something. It doesn't have to be a lot, right? I want $5. I want $10. I want $20. Whatever it is. If they're not willing to do that, you're going to be spinning your wheels and you're going to gain false hopes, right? There is this kind of weird fallacy that happens with salespeople that happens sometimes, that where you feel super productive. You've been busy all day. You don't know what you've done, but you've been on the phone, you've been in meetings doing XYZ. And then you look at how many outbound emails, outbound calls you've done, and it's next to nothing. You create this fallacy. And that's what happens with a lot of early stage founders is they look at their day and they say, oh, I got 20 more email signups. I got 10 more inbound messages. Okay, that's awesome. Get them to pay for something, right? Even if you give it a 90% discount, it's going to tell you, all right, people are willing to pay something for this, right? And it tells VCs as well, it's like, hey, look, it's not just email. I got 10,000 email signups, but I also have 100 paying customers. We give them a big discount to come on board early, but it shows that there's PMF, right? So the number one thing is it's money. Money talks, right? If you can't get someone to pay $5, either they are not a good customer for you, or your product isn't ready yet. Plain and simple. But it doesn't have to be anything fancy, right? Um, just get something. That's the best way to validate whether or not your idea. Because if your idea is so strong, right? Your idea is like, oh, I've got the best idea in the world. I know I can execute on this. Well, it's not going to be great if no one's willing to pay for it. If you can't get someone to pay $5 for your idea, then what makes you think a VC is going to give you millions, right? So this is once again, barring some very crazy pedigree, that is the best way to do it. Is to get that validation, and that doesn't cost you any money.
Right. The ideal is that a startup has some co-founders, like two co-founders. One is on the business side and one is on the tech side. Usually it is considered like that. But what if the scenario is startup founder is non-tech and he's not finding any co-founder? Now he thinks he cannot do the startup. On the other hand, there is a tech startup, there is a technical person. He thinks, okay, I'm not finding any co-founder who is good at business, so I cannot do the startup. So how solo founders can still do the startups, either it's fintech or e-commerce, whatever.
Yeah, look, there's a statistical, uh, study done around the success of founders and startups, and it is shown that if you have more than one founder, you typically have a higher percentage chance of succeeding. With that said, it's not impossible, right? Um, Look, as an entrepreneur and as a founder, you're always going to run into problems. And what I find is, especially in early stage startups, right, is the ones that get funded the most are the ones with the most grit, right? So if for me, I'm not a developer. I could start a startup without a technical co-founder. That's not a problem at all. Like, right, I could go out, find some people on Upwork, uh, get an MVP built out. I could build a no code solution using, just manually doing it on my own, which I know I've done it. I've played with the idea of all these I love new tech tools. So I mean, I'm always playing with all the latest tech. You could easily do it. You could build content with Chat GPT. You could use, Airtable to build a back end flow with Make or Zapier. All these are free, or if they're not free, you can spend $50 a month and you would have a good chunk of tools that you would need. Um, and I would make it work, right? Yeah, that would take a lot more time to build it, right? But it's definitely possible. And if you're a tech founder and you've got a decent enough product, pick up the phone, right? If what's blocking your success is finding a co-founder, you're not going to succeed anyways, right? Like there's if that is honestly in my journey. I mean, I've raised millions of dollars, built countless different platforms within the organization. I've even promoted someone else to take over as CEO. So I mean, I've even worked on the transitioning out phase. So I've been through that journey, and I will tell you right now that if finding a not finding a co-founder is the biggest difficulty you have, you're not meant to be a founder. Plain and simple. Uh, the stress that you're going to go under as a founder, especially if you're funded, is so much. It's multiple times greater than finding a co-founder. Like that should, like I'm not saying it's an easy task, right? You want to find someone that's good. I think ideally you want to find a technical co-founder, but the reality is like that is if that's the only problem that I had, I would be pretty dang happy because that is nothing comparison to the stresses that you're going to encounter. So look, I think people that know me pretty well. I'm a pretty fun, easygoing guy, but I also don't like excuses, right? So if if you go to a VC and tell, well, I can't find a technical co-founder, that's why I can't launch. I'm like, okay, then I've got 50 other deals of people that have the same problem that have overcome that. So next, right? Just you got to stop making excuses. There's always going to be a problem. There's always going to be a reason why you can't do something. If you want to be successful, you have to push through it. And life's not easy. Life's not fair. That's just the reality of life. And I think the founders that I've invested in and the founders that I advise, all of them have one problem one way or the other, and they're just gritty. They just get after it. They don't care. They just are relentless. And though, especially early stage, those are the VCs that are going to back those type of people, the ones that are just like, this person's going to never stop. And that I think that's the number one key to success.
Right. When it comes to the launching of a startup, how a startup can launch with minimum resources, and what is the role of a founder and CEO of the startup in whole process?
Yep. So the number one role of a founder is, as any CEO, is does your company have money? Right. If you're going to boil it down to one metric, right? That can be funding, revenue, right? Does your money, because the number one thing that kills companies is lack of funding, right? I'm not talking VC money. I'm talking just having money in the bank. You have money in the bank, you can't pay your bills. Plain and simple. So when you're have no tools, let's say I have no money, I have $0 to spend. I am not a technical co-founder. I would go build a website for free using one of the tons of free website tools. I wouldn't even use WordPress because WordPress you have to have a server. So I would go build one of those free website tools. I would then create a form using Jotform, Typeform, one of those free form tools to take data in, pass it using a free automation using Make or Zapier, pushing into Airtable to store the data and automate all the way back up. Or you can even turn your product into a service. So you're saying, hey, I want to build let's just say I want to build a recruiting tool, right? So I want to I'm really good at recruiting. I want to build a recruiting tool to solve XYZ problem in this field. Start as a service, right? Say, hey, our platform will find you the best candidates out there. They submit a form. You send an automated email saying, thank you for your request. We will send you candidates here shortly. Then you manually go out and find all the candidates, align them, send an email back saying, hey, we found these candidates. Is this something you're interested in? Yes or no? Great. We're going to, for each successful candidate placed, we're going to charge you $1,000, which is, by the way, a fraction of what it would cost to hire a professional recruiter. Now you got $1,000 in your pocket. You do that a couple good more times. Now you have a little bit of money in your pocket to go out and hire a developer or two. Now really start building out the platform. Done, right? But this is what I mean. Like ideas are cheap. Like ideas are shit. They really are because there's probably a million people that have had that idea. right? But there's an actionable plan that someone can execute on with no money, with no developer, no co-founder, as an individual that knows nothing about coding, and can go out and start their business.
Right. So, when a person is going to start a fintech or e-commerce startup, what are the key factors? What are the KPIs? What should be the metrics that he or she should keep in mind? That these are the KPIs that I will be observing. Okay, my startup is growing.
Revenue, revenue and profit. I mean, in today's environment, it's much different than what it was 2 years ago. Like before, it was like, oh, what's your churn rate? What's your retention rate? What's your what's your CAC, your customer acquisition cost? What are all these metrics, right? And these are all important, right? These are all indicators of success. But revenue and profit, and really profit to number one, straight and forward. I mean, that's all that matters, right? On the ecom side, you can have what's your website visitor count, what is your conversion rate of those visitors, what's your repeat purchase rate, what's your customer lifetime value. These are all important metrics. On the fintech side, what is your adoption? What is your deal conversion rate, right? I mean, all these KPIs are important, but the number one KPI, and this is where founders, like especially first time founders, and I made the same mistake, right? Was we need to track all these KPIs. We need to track all these important metrics. And you spend all this time and all this money and all this energy focusing on all these indicators rather than the number one thing. What's the profit? What's the revenue, right? It's important to understand those other levers because once you understand those things, you can focus on those ones that are underperforming in order to make your bottom line better. But at the end of the day, when you don't have a team of data analysts or a BI analyst or anything like that, you do not have the resources in order to make sure that your company is successful other than how much money is in your bank account. Plain and simple. That's all that matters for early stage founders is how much money is in your bank account. If I go to a VC and I say, I have this great product, awesome. How many customers do you have? Oh, I have none. The chance of getting funded right now with that, once again, barring the use case I said before, is very little. If you say, I've got this great product and I've only got 10 customers, but last month we had 5. And we have a pipeline to actually be at 20 this upcoming month. That's what's going to get, VCs excited, right? That's what's going to get them excited. So if you're really looking for funding, you have to have revenue. That is the number one indicator of success, right? You say we've been profitable for 3 months. We're growing 40% month on month. You'll get funded without a lot of issue. But instead of wasting time trying to talk to VCs and pitching, and I talked to a founder yesterday actually. They said we have a business as a SaaS platform in the e-com space, by the way. We had 10,000 customers. We were generating $5,000 a month in revenue. But in December, we closed everything down so we could rebuild our app, and we're launching again next month. I'm like, what? I'm like, okay, well, I'm not interested anymore, right? You had metrics; they weren't amazing, but you had revenue coming in, and you shut it down to rebuild your app, right? Like there may be a really good reason why you did that. Like just keep doing what you're doing, and then build another app in tandem to that, right? Like to me, I was like, that immediately was a red flag that said this person cannot get focused on what's important. They're focused on the wrong metrics and they shut down their entire business for 4 months to rebuild their app. Like that was a red flag. And I told him right there on the call, I said, look, it's not something I'm interested in, but here is the reasons why. And I give him very candid feedback as to what he needs to improve on. But, I think these are the things that are extremely important when looking at, which direction you're going to go.
Right. Jordan, I'm following you for the last couple of years. What interesting I have seen on your profile is that you were working as CEO and founder, for the QisstPay, but very after, I guess, 2.5 years or maximum 2 years, you stepped down and now you are the chairman and you have hired the CEO, I guess.
Yep.
There is something, team is very important. what was your strategy, and what strategy and tips would you like to give to the other startup founders and entrepreneurs, that how to build a team? Because stepping down from the CEO very quickly is not easy, what I guess.
Yep. It's a big ego thing, right? It's very difficult. And look, this opinion was not popular when I was raising VC funding, and I was told never to tell this to anybody, right? And it's interesting because now this is is becoming much more popular. My definition of a good business, funded or not funded, is a business that where you can step away from it and it continues to grow, right? That has always been my definition of a good business. And when I look at where we're at now, the team, it's not one person. Be like, well, who's running things? I'm like, well, the CEO is running things, of course, right? But he could step away, and we've got 8 other people that would be very good candidates for that. And that's just inside the team, right? So for me, when I looked at where the business was going, right, and how it was growing, I said, look, I'm really good at early stage stuff, right? Really pre-seed, Series A, maybe Series B. And I said, I'm really, really good at this. I'm really good at the merchant acquisition. We had over 2,000 merchants on our platform, um, you know, million plus customers. We had all the right metrics, right? And things are going well. But at the end of the day, I said, I think that this person is actually better equipped to run the company than I am. And that's a huge ego blow. That's a very difficult thing from a founder perspective. It's difficult to make that decision. But when I said, if they can run it better and they can make the company more money, I have to do what's in the best interest of the company, not what's in the best interest of me. And as a founder, that's a very difficult decision to make because a lot of times you are the company. And I've always wanted to get. I've never liked being lumped in as you're just this, right? So it's always you're just a good account manager. You're just a good salesperson. You're just a good sales leader. And it was you're just a good CEO in Pakistan, right? I don't like that because that means that I'm getting comfortable, right? It means I've teetered out on my growth path, right? So now I want to see, hey, can I do it again? Can I do another startup? Can I go join another startup that's early, right? And can I help them grow? Because if I can do it for myself, let me see if I can do it again for another company, right? Because I've seen so much in my very short lifespan. But I think it's important that you do what's best interest of your business and take ego. Like I told this my last co-founder this all the time. Ego is the number one killer of startups. Well, number two startups. The number two killer startups behind not having any money. Because you start making decisions for vanity rather than for results. And I think being a salesperson at heart, it's results are always the thing that speaks to me. And it was to see the company become profitable and to continue growing and we have some awesome exciting news coming up in the very near future, which I'll be excited to announce. But it is difficult to take that step back. But to me, like I think I don't care what anyone else says. I'm sure there's a lot of people that are shit talking me like crazy, like, oh, I blah blah blah, doesn't like this, doesn't like that, whatever. But at the end of the day, like I'm happy with my decision. The company is still growing. So I mean, I'm I'm extremely, extremely impressed with the entire team on how well they've done. And I think it shows that, you know, this is the path that, sometimes the founder needs to make that decision. And it's for me, it was the right one. And if I had to go back, do it all over again, I would do it the exact same way.
Right. Jordan, you know that customer is king of the business, customer is king of the world. So, in general, what are some strategies and tips to acquire the customers and to retain them?
Yeah, so I think it's one of the things that I'll try to take it. I'll kind of make it a bit more abstract than that. It's that look, you can get customers by buying them, by having a good product. You can retain them by having good customer service. I think everyone knows those metrics, right? But let's take it a step back. And I think one of the key things that a lot of and I did the exact same thing. And I've done this not just in my startup, but other companies as well. And I actually just made a LinkedIn post about it, about how my goal was focused on closing the deal and hitting my revenue numbers. That's what I was focused on. I didn't care about anything else. As long as I hit those, I'm good. That's all I care about. But when you talk about acquiring and retaining customers, it can be extremely expensive, right? So focusing on what your ICP is, your ideal customer profile, so that you are not straying too far from what you're focused on. So if you say, I am a e-commerce company and I'm extremely focused on the gaming segment, and I really only want to focus on peripherals. I want to focus on mice, keyboards, headsets. That's it. Once you start, someone comes and say, "Hey, I like your stuff, but I don't want to buy this unless you happen to have a gaming PC that I can buy along with it." Well, that's a distraction, right? I'm not saying that eventually you won't sell those things, but now it's, hey, now I've got to have product availability for this. It's not just, hey, I'm going to make this one sale. There's a couple other people who are going to buy it. I have the product availability, specialization. I need more. Now, a PC takes a lot more space than these other products. I have to have more space to store it. I then have to have a more complex order management system because now I have to have an entirely new set of SKUs into the platform. I then need to have customer service that knows how to handle those type of requests, because now the request is, hey, not how many buttons does this mice have, but hey, does this PC work with this game and that game, and what are the specs? Every time you add a new feature and you try to appeal to a new segment, it becomes more expensive and more complex to run your business. If you focus on your ICP and you're not afraid to turn away deals that don't align with that, you will have a lot less stress and much better margins, better retention, and lower cost of customer acquisition. So my number one tip is find out what your ICP is and stick to that for as long as you can. And the only reason you should go beyond that is unless you have an amazing opportunity, like Amazon comes to you and says, hey, we'll do business with you if you do X, Y, Z. Or if you're like, hey, we've really started to see growth slowing. Or if there's a very strategic reason. But there's very few early stage startups that I would recommend to, that would say, hey, yeah, go out and expand your product set. Or, hey, go out and expand your user base. 9 times out of 10, it's just not going to make sense.
Right. Jordan, what are some common mistakes that entrepreneurs make in the whole process? Either it's building a product, launching a product, or scaling. What are some common mistakes that they make actually, and how they can avoid that?
They don't pick up the phone. Number one, that is the number. I've talked to a lot of founders, especially after being funded. Um, you know, the number one mistake is people are afraid to pick up the phone and cold call a customer. And that is, look, you can be product led all you want, but unless you have funding to be product led, it's not going to make sense. I'm talking about early stage startups. I'm talking, if you're making less than $10,000 a month in revenue, I'm talking to you, right? You are afraid to pick up the phone because you're afraid of rejection. And look, cold calling sucks. Your pickup rates are going to be a couple percent. Conversion rate's going to be even less than that. It's a very difficult thing to do. But if I will say, I'll tell you this, I would rather back a founder that has no product and is willing to pick up the phone and get rejected 1,000 times than a founder who has an amazing product that is afraid to pick up the phone. At least in the early stage. I'm not talking if you're like Series A, Series B. That's a completely different segment. I'm talking if you are early stage, I would 9 times out of 10 back the founder that is not afraid to pick up the phone. Hands down. That is I will tell you, every company that I've tried to help that is early stage, and I'm not talking about, I've had probably 4 this year alone, just this year alone, 4 or 5, that they have a product, they're convinced they have a great product, and they're like, we need to grow more, and they're just afraid to pick up the phone. And all of them are either failed, or in some weird holding pattern of, something else. You've got to pick up the phone and dial. If you're afraid to do that, your chances of success go down dramatically. And especially as the founder, your product best, the vision best, you can make the shot, the calls that you need to make in order to get it across the line. But I think that's the number one thing that I would say an early stage founder makes a mistake on, is being afraid to pick up the phone.
Right. Jordan, how a startup owner could know that it's ready to scale? Let me add a very interesting use case. Airlift. Airlift raised $109.2 million. Dollars. Usually, it is considered that when a startup is funded, now it will be successful. Is it the case? I mean, when Airlift failed and shut down their operations, they were actually scaling. They were going to scale a lot. So, what actually happened usually with the funded startups that they got a lot of funding, but still they failed? Why?
Yeah, so Airlift was caught in an unfortunate timing, right? They kind of got caught in the middle of a funding crunch, right? So it was very unfortunate because the look, ever it's so funny. Like all the posts on LinkedIn that I see, and like, oh, we got to focus on core metrics of profitability is the number one important thing. It's like, but that's not the rule book that they were playing by. Like the past 10 years, the rule book was this. And look, everything goes in ebbs and flows, so it'll go back the other direction in another 5 years. It's just part of the cycle that we're in. But their model was scale, 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 fundraise, scale, 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 fundraise, scale. Eventually, we'll get bought up by some other larger company, or we'll have so much market share that we'll then raise our prices up 50% and we'll become profitable. Right? That was the model. Unfortunately, they got caught in the middle of a funding crunch. And that happened to tons of startups. I'd be like, oh, these are terrible companies, don't know how to run things, blah, blah, blah. It's like, no, but that was the strategy. It didn't work. It worked for a lot of companies. And a lot of people made a lot of money. It was just timing of the market, right? You can't control these macroeconomic things. It's like, look, in Pakistan, when we started, the exchange rate for a rupee was 150, I think. Now it's almost 300. So, I mean, any money that we've invested in Pakistan is halved, right? Plus all the political discourse and everything else with the economy and with all the brain drain that's happening. There's these large macroeconomic things that you just can't control, right? At the core of it, they didn't have good unit economics, but once again, if they when you have funding, you can essentially buy your way out of your mistakes, right? And that's really important because if you have enough funding, you can basically just keep focusing on the growth rather than kind of the core problems, just buy your way out of the problems, right? And I'm not in this environment, you can't really do that. But a couple of years ago, there was tons of companies that did it. That's how Uber got. How do you think a company goes from 0 to 1 billion in a couple of years, right? It's that model, right? And now look, Uber is. I can't remember what their market cap is at the moment, but I mean it was massive. Airbnb, Google. I mean, all these companies grew through this same model. It's just the market timing was better, right? And a lot of people it's funny. A lot of people like to shit on Airlift and all the other companies that have failed, but the reality is they paved the way for a lot of other startups, and they create a lot of positive press for the markets that they are operating in. And a lot of people like to shit on them, and it's very unfortunate because and look, I'm not saying that everything they did was positive or every effect that they had on the economy was positive. They raised wages, which is a good thing, by the way. But like at the core fundamental thing is that it was market timing for them because if Airlift were to start in this environment today, their growth strategy would be 10 times different than what it was a few years ago, right? So a lot of it was just market timing. I mean, there's a lot of other reasons you could talk about why they failed fundamentally, but once again, the fundamentals of hyper blitz scaling startups is different than core unit economics, right? And that's the two differences is which macro environment are you in? Because if you are a startup focusing on the core microeconomic functions, the problem is that your competitors will just outpace you and outgrow you, gobble you up, and kill all your market share, where you can't operate because they're essentially subsidized through VC funding, right? So you die, right? But people never remember all those other small companies that attempted to grow and couldn't keep up and lost because the bigger players are just too well funded. People forget about those players, right? But it's really just macroeconomic changes, right? And every business has to change. And that's why being a founder, you have to be flexible, and be willing to change with the times.
Right. This will be the last question, Jordan, and after that, I will take advice for the startup founders. When it comes to raising funding, what are the basic numbers that an investor see when a startup founder approaches him or her for the funding? So what is the checklist that investors see when we talk on the revenue, team, and business model?
Yeah, great question. So, TAM, total addressable market, is a huge one, right? That's probably one of the biggest ones. They're going to look at the founders, right? What's their background? Are they a previous founder? If you're a previous founder, you have a much better chance of getting funded. They look at, obviously, customer acquisition cost is big. They look at the churn rate. If you're super early stage, a lot of these things are very hypothetical because you don't have enough data to really back it. But if you go look, if I had to do it all over again, and I said, I've got limited access to funds, and I was a first time founder, and this is why people back first, second time founders, failed or successful, is because they have all these crazy learning lessons. Is that number one? I would focus on the revenue. I don't know if I would talk to an investor. I would get on their radar, like maybe say, hey, my name is Jordan. This is what I'm working on. We're not fundraising, but I'd love to just get on your radar. Would it be okay if I put you on my investor update list? You say, sure, have a conversation. That would be it. But if you walk into an investor and say, this is how we run the slides. Intro slide, this is what we're doing. Here's the team. Here's the problem. Here's our solution. Here's the overall TAM. And here's one slide with all our metrics. Here's our revenue over time. Here's our churn rate over time. Here's our CAC over time. Here's our burn over time. Last slide would be the ask of, I need $500,000 on a $5 million valuation. This will allow us to hire 2 more developers, 1 salespeople, and this will actually extend our burn another 18 months. And on top of that, we are, because of our revenue, because of our pipeline, we're actually able to, become profitable again. We're already profitable, but we're able to become profitable again in another 6 months. But we want this money to help hypercharge it. If you go in with that, if you went into that presentation, your funding would be pretty solid. Be like, look, and obviously within the TAM, you'd want to show the competitors, right, that you're going against and what makes you different and all that other jazz. But I would feel very confident about getting funded, even in this environment, if I were to show that and really focus around the metrics. The vision is important, the TAM is important, but just saying, hey, here are my raw metrics. Profitable, we're making money, we're growing pretty fast, and we have no funding today. That's exactly what I would show a VC if I were to go start all over again.
Right, Jordan, it was really insightful talking to you. And trust me, I'm sure that out of this podcast, a lot of potential entrepreneurs and university students learn a lot. Last is not the question, but an advice from you. What would you like to advise to the university students, potential entrepreneurs, and those who are already in the startup? Any inspirational, any message that could help them to be successful in this startup journey?
Yeah, so if I was a university student, just get out and do something. It doesn't matter. Like start a startup. Like there was this great podcast I was listening to. This guy was talking about how he went to a university, and they're like, "Yeah, we're going to start this startup. We're so excited." And the guy went back 6 months later, and he said, "Hey, where are you guys at on your startup journey?" And he's like, "Oh, well, we're still building it. We're actually trying to form our LLC now." And they're like, "Was you haven't built anything?" So they wasted 6 months procrastinating. I talked about that earlier, right? Was busy work, right? You're trying to find this busy work instead of focusing on the results. Just don't worry about the LLC. Don't worry about any of that junk. Just build something. Get the experience of building a product, cold calling customers. Like if I were to say I have zero skill and I don't know what I'm going to sell, I would say I would honestly just pick up the phone and say, call somebody, say, hey, my name is Jordan. I'm starting a new startup. I'm trying to find out what problems you're having in your business so I can build a platform around it. Can I take 10 minutes of your time just to understand it? If you can get past the fear of cold calling and you can learn some basic tools like using Airtable, using Figma, InVision, if you're a developer, learning how to be a full, I think it's important to specialize, but as a startup, a lot of startups hire full stack developers for reasons I can go into later. But say, hey, look, I'm not the best, but I know how to get things done. If you tell me go get this done, I'll figure it out. Having that mentality is the number one thing to get hired by a startup. Be like, look, I don't have a crazy successful startup, but I built $1,000 MRR, monthly recurring revenue, off something I built out of my college dorm room, and I want to go work for a startup and really learn how to scale things. They hire you like crazy for the early stage startups. If you have pre-seed funding or you're at least making some money, go hire an experienced founder to work on your team. Go find someone that has built a startup before. The amount of value you're going to get, and they're going to be expensive, right? Don't get me wrong, but the amount of contact and experience and having someone that you're going to have as a founder, you're going to have stresses that no one will understand. It's very, very few. You're talking like a limit of maybe a few thousand people in the entire world that will understand the frustration. And you cannot seem weak, so you cannot go to your team and be like, I'm having these frustrations. It doesn't work. Finding someone that can help you through that and biting the bullet and spending the money on someone that has experience doing what you're doing will probably 4x your chances of success. If I would have known that all over again, if I were to start all over again, and the second I got my pre-seed funding, I would have hired a previous founder at an executive level come help me build the company. That was my number one mistake going back, was not doing that. If I would have done that, my life would have been a lot easier. I can't even put it into words. That is the number one thing I would have done differently. So just get involved, do something, try building it yourself, be willing to be gritty. And if you're a little bit further than being a university student and you've got some funding or some revenue, hire someone that's done it before. You will not regret that decision.
Thank you so much, Jordan, for joining. It was really awesome. I learned a lot since I'm also the startup founder, so I learned a lot while you were talking. So if I learned, so I'm sure that my audience will also too. So thank you so much for joining. Hope we'll talk to you in future too.
Thank you so much. I appreciate the time.